Okay, so this is my first clip pertaining to Chapter 18 in your textbook. In particular, it refers to pages 611 and 612, and also, which is on the IMF and World Bank, and also in your textbook, Chapter 18, page 609, pertaining to revaluations and devaluations. Okay, so the purpose of this clip, and maybe the next one, I'm not sure how long this will take, because I'm just taping this right now, is to look at what the IMF and the World Bank were created to do. It was sort of in the end of World War II. Actually, I think the war was still technically going on because it was 1944 actually that this happened. So the war was just, still had about a year to play out. And they had these sort of negotiations in New Hampshire in the United States at Bretton Woods. And so we got these IMF World Bank agreements came out of it. So I want to talk about what they were doing, why they did this, what it was all about. Also, it kind of ties into my previous discussions about exchange rate. Remember, I made about 6 or 7 clips. I can't remember how many I made about exchange rates. We talked about fixed exchange rates versus the floating or flexible exchange rates, the free float, or flexible exchange rates. I'm just going to turn off my MSN here because people keep signing in. The IMF was actually sort of set up in this Bretton Woods deal as sort of like an intermediate case. So if you think of the fixed exchange rate as one extreme, right, and you think of the flexible exchange rate as the other extreme in the exchange rate world, this is sort of a middle case, so to speak. It's called an adjustable peg system. I'll talk about that as well. Okay, and also I wanted to sort of talk about what your textbook discusses on page 609 under the heading Government Influence on Exchange Rates is really an example of the logical fallacy of petitio principii, this begging the question. I mean, they basically say that countries should actively be involved in revaluing currencies. In fact, let me read this. This is just unbelievable. I can't believe they said this. They said, what happens when a currency becomes overvalued or undervalued? A nation's economic authorities may take action to correct its balance of payments conditions. Typically, they will devalue or revalue the nation's currencies. Wow, that is a radical statement. It doesn't seem like that, but it really is. Because the history of all of this, which I want to talk about as well, in the 1930s, and also some in the 1920s as well, is what's called that beggar my neighbor policies. I think I talked about that previously in another clip somewhere else, but this is where this all comes back. In effect, and it also brings back in my little discussion about game theory, where we look at the difference between free trade and the mercantilist philosophy, the neo-mercantilist philosophy of exports are good, imports are bad. If you recall, the beggar my neighbor is when a country decides to do just what your textbook said. Let's go ahead and devalue your currency. Well, unfortunately, your textbook seems to forget that other countries are not stupid, and they realize that if they're getting sort of screwed over by your policies, they will react and retaliate. And so what ends up happening is this sort of spirals out of control. That's what these institutions like the IMF were created to prevent from happening. They were designed to stop countries from doing these competitive devaluations because they're destructive. And in fact, as I will point out, some have argued actually made the Great Depression worse. So this idea that we should typically devalue our currency a lot, I don't know. It's begging the question. It's a petitio principii, because it's actually a very controversial policy to do. And to suggest that it's a good thing to do without presenting the fact that it caused a whole bunch of crises in world history gets me nervous. So now, looking at my time here, I think I'm going to make more than one clip on this, because this is a very important topic. So maybe you will get more than one clip after all. Okay, so let's see my notes here. I got 3 pages of notes on this because it's very interesting. So the Bretton Woods Accord, as I said, started in 1944, lasted until about the 1970s, mid-1970s. So sort of the post-Second World War economic recovery plan. Okay, so if you think of this as sort of like a recovery plan, we just had, well, actually, the war was still going on. All these countries like Germany, England, Italy, France, I mean, everyone's just getting bombed to smithereens. Japan as well, right? And also India was in the war. I mean, everyone. China was also attacked. So you have all these countries are sort of because Japan had sort of its Eastern Empire. Germany had its sort of empire in Europe, so all these countries are getting destroyed. Even in Africa too, they also had wars in Africa as well, in northern Africa. The famous Rommel, the desert fox, came out of this as well. Remember also the Suez Canal was an important choke point, as well as the Strait of Gibraltar, and off of sort of the Morocco, southern Spain. That was also an important strategic point as well, to control shipping in and out from the Mediterranean Ocean. So we had Africa, Europe, Asia, United States too. Remember, Hawaii got bombed, Pearl Harbor. So everyone's involved in this. Even South America to some extent too. There was some naval battles down there too. So it was truly a world war. People are getting killed everywhere. Buildings are getting destroyed. So this whole thing is sort of, how do we rebuild the world, basically, in this post World War II era. And so that's why we got the World Bank. It was actually originally called, what was it called? Some International Bank for Reconstruction and Redevelopment, World Bank. And that was basically what it was for. It was set up to help the so-called belligerents, right, the warring sides, rebuild their shattered economies. It also had a secondary sort of goal, which was because, of course, when you have all these wars, you pretty much destroy these countries. Like England and Germany and so on, they lose control over their colonies. You have to remember that England, of course, Britain, had this sort of worldwide dominion. Canada was part of it, remember? The Dominion of Canada and Australia, they were all sort of former British colonies. So you start, and they also had colonies in Africa as well. They were all over the place. And because England is suffering, it sort of loses control of its colonies. So the secondary mandate of the World Bank was to help these colonies, as some of them start becoming more independent, to help them develop and modernize their economies. So instead of just being, here's this colony that we're just going to take all the natural resources from and ship them out, to help them actually develop some sort of economy. And that's why, as your textbook mentioned, part of what the World Bank does to this day is sort of an infrastructure loans, so helping countries build schools and roads and power plants and hospitals and different things like that. Okay, so I'm going to make a second video now on this very fascinating IMF Bretton Woods World Bank setup.